Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, September 6th, just before the close. Little dose of volatility this week. Remember, last Friday on our video, we spoke about the earnings per share of the Magnificent Seven starting to moderate. In Q4, putting together an earnings number year over year, somewhere around 19%, whereas the 493 other companies in the S&P were looking to earn somewhere about 14% growth in earnings per share year over year. You're starting to see some of that movement reflected in the market. If earnings year over year are going to be somewhere in the 18-19% for those seven stocks, it's difficult for them to maintain that forward earnings PE ratio of 30, 31, 32. So it's moderating a bit. There'll be rips, there'll be dips, but as far as the intense buying we saw in late August goes, that pushed a number of these names into an area that you would expect a pullback. And that's what we're getting right now. Interestingly enough, I found it interesting, at least, amongst all the volatility in the headlines and the market activity over the last quarter, S&P's about flat. NASDAQ's down 2.5% over the last 3 months. Dow is up. So we're starting to see, again, to repeat our last few weeks' conversation, that breadth improvement, some money coming out of straight technology into areas like the financials, the industrials, recently into staples, into utilities, into defensive names. Be important for us to keep our eye on that because recency bias, you've heard me say this before, is toxic in trading. And often ourselves as traders, and I'm sure as investors yourselves, you get in the mind frame that what has worked will continue to work. And that does that mindset works for a time. But markets traditionally cycle. And there's nothing wrong with Microsoft. We own it. There's nothing wrong with a great company like NVIDIA. There's nothing wrong with Broadcom down 9% today. They just need to digest some of these gains. When you look at what's happening in technology, and I'm one of those people that believe that AI is a difference maker. You have split decision on that. I see so many areas that it's going to reach into for efficiency that those names I just mentioned are going to be fantastic investments. They're going to continue to be. They have been, but they need to reset a little bit, and that's what we're seeing. So what are we looking at next week? Couple things. Let's go back to August. Remember, early August, Japan blew up, down 13% overnight. We came in on a Monday morning. S&P was down 3-4% after the futures had signaled down 5 or 6. That 3-4% in a couple of days after, those levels are the levels I'm interested in. I want to see how stocks trade against last month's lows. When we also factor in what we saw last month was most sectors and stocks, not the defensive ones, but the S&P broke their 50-day moving average, but held their 200-day. It's a sign of a healthy market. You're going to break a 50-day moving average multiple times a year in both individual equities and indices. Let's see over this next week to 10 days if these individual equities and sectors and indices can hold their 200-day moving average. If they can, no big deal. Standard pullback. Those are some of the things on the trading desk that we'll be looking at. Let's not overlook that after a tough 22 and 23, bonds are doing their job. What is the job of bonds? Bonds' job is to create an after-tax return in excess of inflation. So if we're in the, let's call it 3% inflation area for argument's sake, if the current yield in your bond portfolios is 3.5, 3.75, 4%, and Forget about if it's tax-free. Now you're talking about really a 5.5 taxable equivalent, right? Think about that pickup in purchasing power versus that 3% inflation. That's number one. Number two, in volatile equity markets, bonds dampen your overall portfolio volatility. It makes you think clearer. So, doing the job for us here at Cumberland, hopefully doing the job for you. Speaking of bonds, the Moose on deck.
Hi, it's John Musso. I'm the CEO of Cumberland Advisors. It is Friday morning at 10 o'clock on September 6th. This is the early bond report. We saw weakness again this week in economic numbers, highlighted today by an employment report, a jobs report that came in less than expected. The market was expecting 165,000 jobs. It came in at 142,000 jobs. Clearly not what the market was looking for. More importantly, last month, which was about 114,000 jobs, was revised down to 89,000. So you are on this path of cooling numbers. Other numbers this week supported that cooling. The ISM Manufacturing Index, less than expected. The job openings report, the JOLTS report, less than expected, less job openings out there. So this has kind of pushed the bond market yields lower across the board. 15 basis points across the board on treasuries, only 5 basis points really on something like tax-free bonds in the AAA scale. So for example, the treasury market 10-year is now at a 374. That's down 16 basis points on the week. 10-year AAA muni only down 5 basis points on the week to a 267. Why the sluggishness in the muni market? It's easy, it's supply. We have a chart that tracks the 10-year AAA scale to the 10-year treasury yield. You can see how munis really did not go up nearly as much in the spring when people were fading treasuries because of the deficit and some worse CPI numbers and some stronger job numbers. Likewise, lately, muni yields have not come down as fast as treasuries have. The reason has been supply. Municipal issuers are running about 30% ahead of last year's supply. It'll probably even be more by the time the year is done. And what are they trying to do? They are trying to beat the rush of the election. So if they're thinking about bringing a deal to market, they're bringing it now. And it's a little bit of beggar thy neighbor. They're saying, well, do we want to wait until October? No, they don't want to wait till October. They want to do it now because they want to get out in front of the election. We're going to have a debate next week between Harris and Trump. We'll see what that brings. But the idea is that whatever happens with the election, issuers are assuming there'll be more volatility in the market. Therefore, it's easier to sell bonds now. And certainly it's been easier to sell bonds in a market where the overall interest rate is declining when you look at treasuries. But it's like anything else. If all the elephants are trying to get through the revolving door at once, you're not nearly going to have the performance of the treasury market. We have seen this before. We'll certainly update everybody when we get the CPI number next week. We think that's also important to the Fed. So now the Fed has the jobs number, and they had the PCE data last week, and they have the CPI number. And assuming that is a reasonable number, there's no reason to think that the Fed would go back on their basically not promise, but pointedness of saying they're going to cut rates. And we would expect to see 25 basis points on September 18th. My birthday, by the way. Everybody have a great weekend. We'll talk to you next week.
Thanks, Moose. Have a great weekend, everybody. We'll see you next Friday.